This week wasn't a workout, it was a stress test. A full body, high rep, no rest kind of session, and the market tapped out on Friday. Dow down 2.47%, S&P down 2.61%, Nasdaq down 2.47%, Russell 2000 down 3.47%. Third red week out of 5, and the S&P is now back in the red for the year. So let's break it down. We kicked off the week digesting Moody's downgrade of the US debt. Not a shock. Moody's was the last of the major agencies to admit what we already know. Our deficit is ballooning and interest rate costs are rising. The bond market didn't take it lightly. 30-year yields spiked to 5.15%, and that's not just a number, that's the market demanding more return to hold our debt because they're not sure we can stop spending. Meanwhile, the House passed Trump's big, beautiful bill. Tax cuts? Yes. Deficit reduction? Nope. The market read more issuance and possibly more inflation down the line. Then came tariffs. Friday, Trump threatened a 50% tariff on all EU imports starting June 1st and warned Apple, make iPhones in the US or get hit with a 25% tariff. I can't really do his accent. That sent tech sliding and reignited the trade war, flashbacks across the markets. So who got hit the hardest? Big tech, semiconductors, retail, airline, banks, all red. Apple down 7.6% for the week. Where was the strength? Utilities, gold, uranium, and defense names. Gold finished the week up 5.6%. The second best weekly gain of the year. Energy stabilized late in the week, and nuclear plays surged after Trump teased pro-nuke orders. Earnings were a mixed bag. Snowflake crushed it, Intuit raised guidance, Urban Outfitters surprised to the upside, and on the flip side, Ross withdrew guidance, Xerox cut its dividend, and Apple was all over the headlines. Economic data mostly solid. New home sales up 11%. Flash PMIs beat. Consumers still spending. So recession risk stays low, but inflation pressure is still present in services and input prices, and the bond market still uncomfortable with the government's fiscal path. In my view, this is not the time to swing for the fences. This is the time to be tactical. Controlled reps, smart entries, defensive where you need to be. Cash isn't trash, but neither is staying invested. You need to know what you're holding and why you're holding. For me, I favor US large and mid-cap quality, a barbell of value and growth, select commodities, and bonds to hedge some volatility. Think managing fatigue, not chasing pumps. So, what does this mean for your portfolio? The tariff noise is not over. The bond market is still in charge, but in this chop, there are windows not for panic, but for planning. If you don't have a strategy for pullback week, you're just watching reps instead of making progress. Drop a like or hit a follow. I'll see you Tuesday. Markets are closed Monday. Stay profitable and God bless.